Hi everyone and welcome. This is about how interest rates shape your financial world. We're hearing a lot about interest rates in the media, and there's a lot of attention given to the Reserve Bank in Australia and, in fact, uh, all over the world as well. So I'm just going to go into really why they are so important and why there is such a focus on them. Just a quick disclaimer, this information is of a general nature only. It doesn't take into account your objectives, financial situation, or needs, so I recommend obtaining personal financial advice before making any investment decision. So interest rates mean different things to different people depending on where they are. And I'll explore the three key categories, which is savers, borrowers, and investors. Starting with savers, when interest rates rise, savers benefit. If you have money in a high interest savings account, you'll earn more interest. Conversely, when rates fall, your interest will decrease. If your savings are locked into a fixed rate product, say like a 12-month term deposit, your interest rate won't change during that period. So even if markets rise or fall, your return stays the same. In an environment where interest rates are changing, you need to consider whether a variable or a fixed rate product is suitable. So variable accounts will adjust with the market, whereas fixed accounts will stay the same. And this is where, when there's stable interest rates, it's easier to make that decision. But when interest rates are changing, where your money is currently in a cash account, whether it's in a term deposit or in high interest savings account or another type of product, does really matter. So constantly savers are making decisions on whether they should be in one of these products that are fixed, whether they should be in variable or whether they should be in a term deposit or a high interest savings account. These decisions are constantly being made by savers all the time, depending on the interest rates and the environment. For borrowers, interest rates determine how much it costs to borrow. When rates rise, repayments, especially on mortgages, go up. And when rates fall, your repayments decrease. Banks take a month or two to adjust their interest rates, and therefore it flows through later in your repayments if you're a monthly repayment on your mortgage. But basic premise is variable loans will benefit when rates fall, so your repayments will reduce, and fixed loans stay the same. So it can be helpful if rates rise, but if rates fall, your repayments will still remain the same. So although your product may be good now, if interest rates change, you will need to reassess. Again, borrowers are constantly making these decisions on whether to change banks, whether to change their products, depending on where interest rates are moving. The final category is investors. For investors, interest rates act as a benchmark. If your cash earns 5%, you'll expect a higher return on riskier investments like shares or property. When rates are low, say for an example 2%, an investment that's making 5% may look attractive. But if interest rates rise to 5%, that same investment might not justify the risk. This leads to changes in an investor's strategy, which means you have the market where you sell an investment or buy investment. Ultimately, the interest rates help investors assess whether their investments are performing well relative to the bank cash risk-free rate. This ongoing evaluation or assessment of investments shapes and moves markets in terms of shares and property constantly. Just hope that this gives a bit of a overall view on understanding interest rate. It's not just about numbers, it's also about making decisions based on your goals and what the environment is at the time. So if you'd like to explore how that applies to your situation, please feel free to reach out.